So today we are looking at a question that will help us understand how to account for disposal of a fixed asset. Okay. Now you understand when I say disposal. Disposal means to sell, right? So let's say disposal of a fixed asset. Of course, you don't can say non-current asset, right? Now, while we're trying to explain, but we're going to have a brief insight or a brief explanation of what we call capital gains tax. Okay, all right. So you have to understand that as well as an accountant. Okay. So basically, when we say disposal of an asset or a fixed asset, what we're saying is that you're selling. Okay, of course, at this level, you should know what a fixed asset is, right? What are your fixed assets? Your motor vehicle, your land, your building, your furniture, okay, equipment and all that. So we call them fixed assets or non-current assets. Now, what we want to really talk about here is disposal of the fixed asset. When you sell a fixed asset, how do you account for it? So before we go deep into that, let's understand some items. Of course, you understand what it means to say cost. What is a cost? What is the cost of an asset? Okay, that's the value at which an asset is purchased, or the value that the asset is carrying at a particular period of time. So if your motor vehicle is valued at, let's say, 1 million as at today, that's the cost of the asset at today. Okay, so if you're buying a new motor vehicle as well, whatever value, whatever amount you have spent in acquiring that vehicle is the cost of the vehicle. Okay, now because of the fact that you're going to be using the vehicle, okay, and then as you use it, it is believed that the value will reduce. So we say the asset has depreciated. So we have what we call depreciation there. Okay, so depreciation will set in when the value of an asset reduces. Okay, so you buy a vehicle today. By the time you use it after a year, it is expected that the cost of that asset will not be the same. And as a business, from the accountant's perspective, it is expected that you write off the cost of the asset over a particular period of time. Because of course you're using the asset for the business. So the business should pay for the asset over a particular period of time. So what we use to account for that reduction in value of the asset over a period of time is what we call depreciation. Okay, now you should also understand what we call net book value. Just giving you a background, there's a class already on depreciation on Jalos Consulting, so you should go there and take that class. I'm just trying to give us a background so we understand where we're coming from. Okay, so now net book value now is the value of the asset after taking depreciation into consideration. So if the cost of an asset is, let's say, 100,000 naira, okay, and then there's a depreciation of, let's say, 10,000 naira. So this is the cost of the asset. This is depreciation of the asset. So the net book value will be 10,000 minus 100,000 minus 10,000, which is 90,000. So after considering the depreciation, what value is the asset carrying? That we call net book value. So call it carrying amount. Of course, carrying amount can be at end point. Okay. So the value or the amount that the vehicle or the asset is carrying after considering depreciation is what we call net book value, or you can call it carrying amount. Okay. Now you understand that there's something called accumulated depreciation. So you have to be able to differentiate between depreciation and accumulated depreciation. You have to be able to differentiate between them. So now depreciation is a charge for a particular period. But when you now what sum up the charge of depreciation over a particular period, you call it accumulated depreciation. So what we're saying is that if you have, let's say, 3 years, year 1 depreciation charge, let's say 10,000. Year 2, this is year 1. Year 2 depreciation charge, let's say another 10,000 again. Year 3, let's say another what? 10,000. So accumulated depreciation will be how much? 30,000. So when you mop up the depreciation charge over the periods of the usage, you get what? Accumulated what? Depreciation. So that means that your net book value can as well be what? Your costs minus your accumulated what? Depreciation. So that means if you have year 1, the cost is 100,000. What is the net book value at the end of year 1? What is the net book value at the end of year 2? What is the net book value at the end of what? Year 3. So let's just test. So we have 100,000 as the cost. So at the end of year 1, the net value was 90,000. Now, by the time we reach year 2 ending, it would have accumulated to what? 20,000. That's the depreciation, Abi. So what will not be the net book value at the end of year 2? That will be 100,000 minus 20,000. So that means you have what? 80,000. So now, by year 3, depreciation would have accumulated again to what? 30,000. So what will be the net book value by the end of year 3? That will be 100,000 minus 30,000. So what do you have? 70,000. So you can have carrying amount at various what? Periods, or net book values at various what? Periods. Now, as an accountant, we are now saying that you are selling the asset within any of these periods. You can sell it at the end of year 1, you can sell it at the end of year 2, you can sell it at the end of what? Year 3. So by the time you're selling it, you either make a profit or you make what? A loss. So when you sell the fixed assets within the periods, that will call what? Disposal of what? Fixed what? Asset, or disposal of what? Non-current what? Asset. Now what we're saying is, for the sake of illustration, the cost of this asset in year 1 is 100,000. At the end of year 3, what is the cost? 70,000. Let's say at the end of this year 3, we now sold this same asset. Let's say for what? 90,000. We'll say what? We have made a profit on what? Disposal. Because the net book value or the carrying amount at the end of year 3 is 70,000. But we sold it for how much? 90,000. So that means there's a profit of how much? 90 minus 70. That will be how much? 20,000. We have profit on what? Disposal. But it's also possible as well. This one is profit on what? Disposal. Now it's also possible as well that you sell below the what? Carrying amount at the end of the year 3. So at the end of the year 3, you're still having 7. Let's assume you now sold it at what? 65,000 naira. So that means the net book value at the end of year 3 is higher than what? The selling price, or the disposal value, or the sales value, or the sales proceed. So that means there's a loss on disposal of how much? 5,000 naira. So what we're saying is that disposal of fixed assets can either result into what? Profit on disposal, or loss on what? Disposal. Profit on disposal is when what? Your sales proceed is greater than what? Your what? Net book what? Value, or accumulate or what? Carrying what? Amount as at the time you are what? Selling. But loss on disposal will be what? Your what? Selling price or sales proceed less than what? Your net book value or your carrying amount as at the time you are what? You're selling. So what are the double entry principles, or how do you account for it? So I'll take a very simple illustration. Okay? How do we account for it? We have let's say an asset. We have an asset. Let's say motor vehicle. Okay? You know, when you purchase motor vehicle, you're crediting cash, you're debiting motor vehicle, right? So apparently, your motor vehicle is having what? A debit. So let's start with purchase. Let's buy the motor vehicle now. So here, first one, we purchased motor vehicle in what? Cash. So what do? We're debiting motor vehicle, right? Let's even say 100,000. Okay? We debit motor vehicle with what? 100,000. We credit cash or bank with what? 100,000. Okay? Now, for the year, we are charging what? Depreciation. So let's say 10,000 naira. So what do? We're going to say what? This motor vehicle now, remember, is an asset, but I want to reduce the value. So we're going to say credit what? Motor vehicle with how much? 10,000, right? And then what do? I'll debit what? Depreciation. Okay? With how much? 10,000. Alright? Now, that will mean that what? Your motor vehicle value, okay? Let's show it in a T form now. This is motor vehicle. Remember, there's a cash that I wish to purchase, 100,000, right? There's a depreciation here of how much? 10,000. That means the value you're going to be having here, okay, is what? 90,000. That's for the first year. Okay? Now, assuming that by the end of that year, we sold this vehicle now. Let's say we sold it for what? For 80,000 naira. Okay? So we have to close this account and take it to where? Asset disposal account. So how do we close the account? You're going to say what? Credit what? Motor vehicle. With how much is left there, which is 90,000, right? And then we'll now debit what? Motor vehicle or asset disposal account. Okay? With how much? 90,000. This is what I'm saying. This is asset disposal account. Okay? We'll credit this guy here. We'll say asset disposal. How much? 90,000. So that the account will close. So we have 100,000. Closing the account. 100,000. So here we'll say what? Motor vehicle. How much? 90,000. Okay? Now how much did we sell the assets? 80,000. So if you sell, that means you're going to what? Debit cash, which is bank, with 80,000, and then credit what? Asset what? Disposal, right? So if you're credit asset disposal, you're going to say what? Cash, how much? 80,000. Now if you look at the asset disposal account here, you find out that the value of the vehicle is more than the disposal, so that means there's a loss, right? So we'll say loss on what? Disposal. How much? 10,000. So we close the account. It will be 90,000. Okay? 90,000. What this means is that what? This 10,000 will not be an expense in the profit and loss account. Okay? But assuming that the disposal is more than the what? The vehicle cost, it will be profit, have it? So that will be a profit in the profit, and it will be an income in the profit and loss what? Account. Okay? So there are two things. You either make a loss on disposal, that is when you sell the asset, you make a loss, or you make a profit. If you make a profit, it becomes an expense in your P&L. If you make if you make a loss, it becomes an expense in your what? P&L. If you make a profit, it becomes an income in your P&L. So basically, your profit is the difference between the sales proceed and the net book value of the asset. Okay, so when the sales proceed is more than the net book value of the asset, you have a profit. But if it is less than the net book value of the asset, you have what? A loss. So you treat it accordingly in the profit and loss what? Account. Okay, so I've already explained all the depreciation aspects in a class called Depreciation of Fixed Assets or Non-Current Asset on Jalus Consult. So you can go there, take your class on depreciation, and then combine it with the class on what? Disposal, to understand how to account for what? Disposal of what? Of fixed what? Assets. Now this here now is as an accountant. Now from the taxpayer's perspective, Okay, you must understand that the taxpayer does not want to hear depreciation. Sorry, the tax collector rather. The tax collector does not want to hear depreciation. So what I'm saying is that, here we always take depreciation as an expense in our profit and loss account before we now arrive at our profit for the year. But the truth of the matter is that from the tax collector's perspective, there's nothing like depreciation. So your depreciation is adjusted, okay, on the income that is going to be accessible to what? To tax. So usually depreciation is not allowable as a deduction, okay, before you tax an income of a company. So there's what we call the tax account that will be prepared to make adjustment for all these things. Now the question is, if you're telling me that I should not charge depreciation, which is a capital expenditure, of course at this level you know what capital expenditures are. Capital expenditures, okay, are expenditures that are intensive or kind of huge in nature, and as such cannot be written off, okay, at once. So when you buy a motor vehicle, or you plant a machinery, or you buy land, it's not something that you can just hit to your profit and loss like that. So you write it off over a period of time. That's the essence of the depreciation. But taxman is telling you no depreciation, so they adjust for it, okay, to have the profit that will be accessible to the profit. But now the question is, how do we now, okay, find a way to allow those capital expenditures? So the tax person will tell you to do what they call capital allowance. Okay, there's something called capital allowance. So capital allowance, okay, capital allowance is what the tax man is telling you to adjust or take out of the profit that is being assessed to tax before you arrive at the taxable income. So when you have a profit that you report for a particular period and you want to take it to tax. So what we're saying is that the capital allowance will be used to reduce the profit that we're going to get tax on. So what I am saying is, instead of depreciation, taxman is saying capital allowance. So if you bring an account that has depreciation, it's going to be added back to the profit. So then you will now have to adjust for capital allowance instead of depreciation. So the capital allowance, okay, is a way of the taxman's approach to to help you recoup the cost you have incurred on capital expenditures that you cannot charge as a normal expense item. So usually capital allowance, you write it off over a particular period of time. So we have what we call initial allowance. Initial allowance is so long as the asset is a qualifying item for capital allowance. Okay, so we have this initial allowance that you must reduce, you must take out, okay, you must take out of the profit, okay, once in the lifetime of the asset. So if you can get the schedule, there are schedules basically for each item, okay, schedules for land, vehicle, plantation, equipment, machinery. So you can get that, okay, from the Inland Revenue Service. Okay, now as initial allowance, that means you only take, if the asset, if the schedule is saying the asset should go for 4 years, it means that you can take this initial allowance only once in that 4 years. Okay, now what we call annual allowance. Annual allowance is the balance after the initial allowance that you write off on a straight line over the life or the useful life of allowance. So if it is 4 years, every year you're taking that out until the last year. Now there's something called balancing adjustments. Okay, but before that you must understand what they call tax written down value. Okay, tax written down value is the value of the asset after deducting the allowances for a particular period. So for instance, if the cost of the asset, I mean from the tax collector's perspective now, that's the tax account that will bring the tax account for what? For tax purpose. So if, for instance, the cost of the asset is 100,000, okay, and then the initial allowance and the what? Annual allowance that we what? Claim for the year, let's say it is 25,000 for the sake of argument. So that means that what? Your tax written down value will be what? 100,000 minus what? 25,000, which is how much here now? 75,000, right? So I'll say that again. Tax written down value, okay? When you take out your what? Allowance for the year, out of your what? Your cost, whatever you have before we call the tax written down value. So if, for instance, your cost based on this illustration, cost is what? 100,000. The allowances that we have claimed for the year is 25,000. So the difference is how much? 75,000. So for this asset now, the tax written down value will be how much? 75,000. Now what we're saying is that there's something called balancing adjustment. Balancing adjustment is saying that it is possible for you to sell the what? The asset within the period. Now we have tax written down value of 75. Now let's now assume that we sold the what? Asset for how much? 80,000. Now this is from the tax collector's perspective now. The asset is sold for how much? 80,000. You can see that the tax written down value is 75,000. But the asset is sold for 80,000. So there's what we call balancing charge of how much? 5,000. Because the what? Are you there now? The tax written down value is less than the what? The sales proceed is what? 80,000. The tax written down value is 75. So there's a balancing charge of how much? 5,000. So what we're saying is that this amount here, okay, has to be what? Taxed. Okay? But now what we're not saying is that it is also possible that what? You will sell at a value less than the tax written down value. So let's say that you sold, instead of 80,000, you sold for 60,000. So in that case, okay, this is next scenario at 25,000, so we have 75 here. But in this scenario now, you didn't sell for 80, you sold at what? 60. So that means you're going to be having how much now? 15,000. But this is called what? Balancing what? Allowance. So what we're saying is that you're going to use this to reduce your profit further until what? You utilize it. Now, in the case of balancing charge, it will get to some point where, okay, the balancing charge, okay, will be more than the what? The allowance that you have claimed. So what I was saying is that in the area of, assessing or taking the balancing charge to tax, we must compare it to the what? To the what? Allowance that has been claimed. So it is restricted to the what? To the value of allowance that has been claimed. So if, for instance, your balancing charge is 40,000, okay, you cannot, you get the point now, put to what? Tax more than what you have claimed as what? Allowance. So that means that if your balancing charge is 40,000 and they are saying that it is restricted to what? 25,000, that means there's still what? An excess, okay, of how much? 15,000 that is yet to be what? Accounted for tax purpose. Okay, so now in that case, now it means that what? We are going to have to look at what we call the capital receipt and the capital gain of that asset. So in that perspective now, we're going to be saying that what? That asset has what? A chargeable what? Gain. So we're going to have to look at the sales proceed and the cost of the assets now to see if there is what? A profit. Okay? If there's what? A profit called capital gains that we will now charge tax on, called capital gains tax. So capital gains tax is a tax imposed on what? On the gain derived, okay, from the disposal of what? Of a chargeable asset. So when you sell an asset, okay, or when you dispose of capital expenditures, there's a capital gain that is what? Usually earned on that what? Asset or on that expenditure. The gain on that expenditure, okay, is what we call capital gain. Now the tax on it is called capital gains tax, and it's usually 10%. So this is from the tax payers perspective. So you must understand your balancing charge, your balancing adjustments. And then, in tax practice, profit derived from, capital expenditures, or, let's say fixed assets. An accountant, basically, you don't usually submit them to what? To income tax, except of course if your inventory is an asset. There's a difference between someone that deals in vehicles, that he buys and sells vehicles, and someone that bought vehicle for the aim of what? Helping his business. So to one person, the vehicle is an inventory. To the other, the vehicle is an asset or a capital expenditure. So for the guy that the vehicle is an inventory or a stock, of course the profit on those proceeds will be subject to your normal income tax. But for the guy that is what? Selling, that bought a vehicle for business and is not selling it, okay, that profit is not for income tax purpose, but you're going to what Charter will call what? Capital gains tax. All right, and the percentage is what? 10%. So basically, capital gains is the difference between the sales proceed and the cost of acquiring the assets. So if the sales proceed, for instance, as we have here, is 100,000, and then by the time we sold for, let's say, 150,000. Of course, there's a gain of how much? 50,000 on this on the asset. So this is the chargeable gain. Then the capital gains tax will be what? 10% of what? 50,000, which is how much? 5,000 naira. Okay, so you must understand that from the accountant's perspective, okay, the account reported or the profit reported, okay, might not be final and conclusive for tax purposes. There has to be an adjustment. So in adjusting, you bring in capital allowances and possibly, okay, capital gains. Of course, capital gains even on actual basis. Anyway, of course, while your income tax is on what? Preceding year basis. Okay. So when I mean actual year, I mean in the year of what? Of sale. Okay. But when I say preceding year, I mean, okay, the year before. Of course, you cannot tell the profit you make in a particular year. So if this is 2021, you cannot tell the profit you make by the end of 2021. So you have to assess 2021 and 2022. That's why they call it preceding year basis. Okay. But of course, when you sell an asset, you can tell the profit or the gain you made on that asset in that actual year, right? So what we're saying now is that such a gain is called chargeable gain, and then the tax on it is called what? Capital gains tax. So you are expected to remit it to the what? To the what? Inland what? Revenue. Okay, so this is now a background on capital gains tax, and then we're able to touch a bit of what? Of capital what? Allowance. Okay, so you must understand as an accountant, you might be using depreciation, but the tax person or the tax collector or the tax man does not respect depreciation. He is only concerned about capital what? Allowance. Okay? And when there's a disposal, he compares the sales proceed with the tax written down value. If you have a balancing charge that we have to tax, or a balancing allowance that you what use to reduce your what? Your profit further, before they tax it. And then because of the fact that in practice you do not subject what they call it, capital gains, okay, to your normal income tax, then there's a need for what? The capital gains tax. Of course, there are exemptions. Okay, not all assets, you sold that will have to what? Charge capital gains tax. So, you can just quickly, look into, the various acts, okay, to get to know the exempted product. Or you can as well, like I said, the Inland Revenue Service is there. They are human beings too. Of course, they are there for business on behalf of the government. So if you have questions, you can as well go there. You want clarifications, go there, ask your questions. I believe that will give you, good explanations. And then there are circulars all the time, okay, to help us keep or be updated on the requirements for filing various taxes. Okay, so you can follow up the Inland Revenue Service of your state, Inland Revenue Service of Federal Inland Revenue Service. Okay, maybe on those social media platforms. Them are social media platforms where they also share information. So you can follow them up, to get updates, or you go there to their office to get updated schedules on various tax issues that you think you need clarifications on. Okay, so this class has been able to differentiate between the accountant perspective of disposal and the tax collector's perspective of disposal. So what I was saying is that while you prepare your account as an accountant, you also prepare an account as a tax person. So you see the value when you have an accounting knowledge and a tax knowledge. Okay, so instead of your company having to engage another accountant as a tax person, so you can bring in that value and then of course collect your money. Okay, because it's not easy to come by. So you tell them what you want to give them so you can help them save those sort of costs. Okay, that's on the lighter note, but at least it is the fact. Okay, so that is what it is for this class. If you have questions, you can reach me on the numbers displayed. I'll be there to reply you with the right answers. So quickly, let's take this very short question and then have an idea of what we're talking about now. Top Up Limited purchased a machine for business use on the 1st of January 2010 for 12 million naira. It is the policy of the business to depreciate its asset on a straight line basis. The machine is to be depreciated at an annual rate of 20% per annum. Okay. In December 2011, the machine was sold for 14 million. They're required to show the necessary ledgers to record the above transaction. And then we have the tax record review that the capital received from the asset disposed is exposed to capital gains. What value should be provided for in respect to the tax payable on the gain? Right? So this is a very short question. So let's quickly take the question and then conclude. Yeah. All right, so what do we have? Top Up Limited. So we have Top Up Limited. Okay, so what happened there? They said what a machine for business use on the 1st January 2010 for 12 million was purchased. So when you purchase machine, what do? Of course, you're going to have to debit the machine account. So we say machine account. So we have credit, we have debit. So this is 2010, right? So of course you're going to have to debit machine, credit cash, right? So we have the cash, which is the cost here. Okay, so how much is that? 12 million. Okay, so by the end of 2010, the value will remain the same. Of course, the cost will remain the same. So we have 12 million, right? So that's 12 million for 2000 and what? So in 2000 and what? 11. Of course, you're still going to have a balance brought down, which is the cost of how much? 12 million. Right? But they're not telling us that it was disposed, okay, or it was sold by the end of 2011. Okay? So that means by the end, they're going to say transfer this value here to the disposal account, which is how much? 12 million. Okay, so that this closes the asset account. Okay, now remember that you have used it in 2 years, 2010, 2011. Fortunately, it's December, so it's complete month, no proration. So that means there's depreciation in 2010, there's depreciation in 2011, right? So what would we say? depreciation account, right? So in 2010, there is a depreciation on the assets. Okay? There's a depreciation on the asset, which is what? They say what? 20%, right? They say 20%, that will be 0.2 times what? 12 million. So what do you have there? .2, I think 10% is what? 1 point, that's 2.4. Okay, 0.2 times 12, 1, 2, 3, 4, 5, 6. That's 2,400,000. Right? So what we're saying here is that 2010. Okay, so we have accumulated depreciation here. Okay, to be how much? 2,400,000. All right. So you're taking this to what? Profit and what? Loss. To what? 2,400,000. That's for 2010. 2011, the same thing. Accumulated depreciation, 2,400,000. Profit and loss will be what? 2,400,000. Okay. So that is it for the 2 years. So the next one there, of course, you have what? Accumulated depreciation account now. Right? Yeah. What do you say? Depreciation, right? That's for 2010. 2,400,000. So you have what? Carry down here. 2,400,000, right? So in 2011, this becomes a breakdown of what? 2,400,000, right? They have another charge here. Depreciation, 2,400,000. So this should give us what? 4,800,000. But instead of balance carry down now, I know we are selling, so take it to disposal. 4,800,000. 4,800,000. Right? So let's go. The next one now. That will be the what? Let's call it the disposal now. Disposal account. Right? From here, we transferred the machine here to do what? 12 million, right? Now, from here, accumulated depreciation, 4,800,000, right? Now, they said we sold it for 14 million. So if you sell, that's like the proceed. What do? You what? Debit your bank or your cash and credit your what? Disposal. Right? So here we say bank or cash, it's what? 14 million. So the difference will tell us there's a profit on disposal or a loss on disposal. From what I'm seeing, I can see what? A profit on what? Disposal. Alright? So what do we have there? So that's like saying that we have, what do you have there? 4,800,000 plus what? 14 million. Okay? That's 18,800,000. 18,800,000, right? So the difference between this and this now will be your profit on disposal. So what's the difference? Minus 12, 1, 2, 3, 4, 5, 6. I have 6,800,000. 6,800,000. So what do you have? 8,800,000. So from what now? the accountant's perspective, the disposal on this asset has a profit of 6,800,000. So this will go to profit and loss. Okay? As an income for the what year. So this is it. Of course, if you want to open the ledger for bank, you just, what do you have? You have your bank account here. Okay, when you purchase, that was 2010. When you purchase, of course, you're going to credit bank. But there's not enough information. Is it a loan? Is it capital? So let us not begin to ask questions. Okay, so here now, it will make it look like an incomplete record, which I don't want to do that impression. So if you say you purchase, so where did you get the money from? Is it the bank loan? Is it, So let's not go there. If it's an incomplete record, I will start interpreting like the bank loan. Is it capital? All those that. Okay, we'll take our time. So I don't want us to go into that. But if you have issues with incomplete record, you can go to jalosconsult.com. I taught incomplete record there fully. Okay, so here now we've been able to account for the disposal. Okay, of course this is bank, debit bank, it's an inflow. But the profit on disposal here is what? 6 million. So that will go to your profit and loss account in the credit side of P&L. Because your P&L, credit side is for income, debit side is for expense. Your debiting disposal and credit your P&L. Now they're not asking, they said what? The tax record revealed that I've already told you that the profit you report from the accountant perspective is not what the taxpayer will use. The taxpayer will have to adjust based on its own provisions. Okay? So the profit from the taxpayer accountant perspective, not the same profit from your tax collector's perspective. So if you're preparing an account based on tax for tax purpose, there are ways to go about it. Of course, you will need the account prepared by the accountant, but there are some adjustments based on tax provisions, acts, principles, practice, and all that. So from the accountant perspective now, the profit you have made on this disposal now is 6,800,000. But they're not saying that the tax record revealed that the capital receipt on the assets, capital receipt is not like the capital receipt, money got from the disposal of the machine. The tax record that the capital receipt on the asset disposed is exposed to capital gains. The capital receipt on the asset disposed is exposed to capital gains. What value should be provided for in respect to the tax payable on the gain? I already explained, okay, that gains on disposal of asset or gains on capital expenditures, okay, are subjected to capital gains tax of 10%. Okay, I already told you that, of course, while the tax man is not allowing depreciation, okay, he is allowing capital allowance, where you use your initial allowance and your annual allowance to reduce your the profit that is accessible for tax. Of course, I also explained that you can have balancing charge or balancing allowance. The balancing charge means that you have a profit that should be subjected to tax, but must be restricted to the allowance that you have claimed. And then you have your balancing allowance, which means that you have to further claim some reliefs on the allowance. And I said that, okay, for in practice, that's profits on capital expenditures are not subject to income tax. So you bring them to capital gains tax. So from that explanation, we'll look at this now. What is the capital gains on this transaction? Of course, the machine is a qualifying expenditure. I told you to look at the schedule to know the assets that are involved. The cost there, or cost of acquisition, is 12 million. So let's just quickly do that here. Let's say capital gains tax. Okay. So what do we have? Okay. So what do we have? We have sales proceed. How much is that? 14 million, right? So what is the cost of assets? 12 million, right? So if you take that out, what do you have? So this is chargeable gain. All right? So the capital gains tax now will be 10% of this at 10%. So 10% of 2 million, that's 200,000. So we have 200,000 naira. So the chargeable gain is 2 million naira. Capital gains tax is 200,000 naira. That's like 10%. So that is what the accountant will make provision for to remit to the revenue service. Okay, so this is basically, a brief or fundamental explanation. Okay, should I say an introduction into what is very reasonable to practical sense. Okay, into capital gains. We also looked at some capital allowance terminology there. So go through it. If you have questions, you can reach me on the number displayed. I'll be there to reply you with the right answers. Of course, this is the accounting perspective of disposal of an asset. And then there's the tax perspective of disposal of an asset, which I've also explained in this class. So like I said, of course, you can always support us by paying to the account displayed. Okay, so we can continue what with. Of course, we're going to continue anyway. All right, and then I have my textbook. Like I said, I want us to distribute it to as many students as possible, so you can support by what sponsoring copies, so we distribute to students. And then of course people are sponsoring, and then by the time we start distributing, we're going to be posting them on this our page here. And then we're going to have the list of what sponsors, of course, on the website jadosconsult.com, where you can see the list of those sponsoring and donating from time to time. It is quite transparent. That's what we are. That's what we stand for: integrity and accuracy. Of course, that is the motto for the Institute of Chartered Accountants of Nigeria. So basically, whichever way, just know that we're transparent. If you have questions, clarifications, even how we are doing it, you can call. We're ready to explain ourselves to your satisfaction. Special thanks to Engineer Henry for sponsoring copies. Thank you so much. Okay, so we're expecting more good or kind-hearted people to sponsor copies. Thank you.